The stock market woke up in a good mood this morning. It looks like the markets are going to open up in the green. The Nasdaq, the futures is looking like it's going to be up 1.53%. The S&P is going to be up 0.8%. Dow is up 0.44%. So things are looking pretty rosy. And I'll get to the economic reports that were released 30 minutes ago that could have affected this market. But what's interesting is the market was up at these levels before the economic data was released. So the economic data, if anything, just helped. It didn't hurt. And I'll get to that in a minute. Oil prices went down, are down 2.37. And that, again, oil prices going back in the 60s. That makes oil affordable, and that's going to help with the overall inflation struggles that we had in the past. If oil prices are down, gasoline prices are down, that consumer is feeling relief. So we got good news on the oil front. With regards to the economy, lower oil prices is going to make oil companies prices of their stocks go down. So a little bit of bad news for the oil and energy complex. So stock market's going to be flush. Let's take a look at that economic data just to review a few things. And I have to reset my expectation on the economy a bit because data is data. The GDP report, it showed that GDP came in at 3% GDP growth. That's very good. So previous 1.4, this number was beginning to somewhat influence me to think we're seeing a slowdown. And now I'm looking at that 3 going, that's a pretty good number. That shows that the economy is fine. It doesn't show a lot of weakness. It shows that the economy is fine. I'm going to combine that with the report that the Chinese government provided on their economy. Their economy is growing at 5%. So the 2 biggest economies in the world are growing. So that's good news. That's good news for companies that are trying to sell their products. It's good for people that have jobs. They're going to have more jobs because the economy is doing well. So that was very good news overall. Initial jobless claims, another thing that could add one more, piece of information that can drive the economy. And the news was positive. The initial jobless claims were lower than expected and lower than previously reported. So another bit of good news. So my psychology was we're headed toward a slowdown. I'm not going to claim we're going to have a harsh, recession, but this data interrupts that thought process for me. The GDP came in favorable, initial jobless claims favorable. If the data stays where this is at, what recession? So it leads me to think, well, what's the Fed doing, like lowering interest rates? There's supposed to be a very aggressive interest rate reduction plan that the Fed announced. And I'm looking at these numbers going, and why do you need to do that? It'd be nice for the economy. You're going to make GDP growth accelerate, I guess, and you're going to keep unemployment down. So I guess the Fed wants to make sure that the jobless reports continue to stay really low and unemployment stays really low. I can understand that. They're just going to empty kind of all the ammunition they have to potentially really do deal with a recession should we have one. If they start doing it really early, what are you going to have left? Maybe in a year or 2 years' time. But that's their job. My job is to manage my portfolio, see what's going to happen going forward. I felt that for the remainder of 2024, especially here in September and in October, we're susceptible to a good correction because we have this election, which even the election, I mean, I haven't heard a lot of stories that are like, shake you in your boots kind of stories that, oh no, this is going on. It seems to be it's calmed down from what I was hearing, a month ago. So hey, it's a nice Thursday morning. I'll take it, man. I'll take the upbeat reports on the economy and likely see the stock market rally today. It'll be interesting to see, and the bears will have a bad day, and the bulls will be partying on Wall Street. What's been interesting is that interest rates, I think I've seen consecutive days of interest rates going up. Now, this is something that, I like to invest in things that are going to be really good a year from now, maybe around that time. And it feels like nobody's paying a whole lot of attention to interest rates, but you could see that in the last month, interest rates have creeped up. Now, as interest rates creep up, prices of bonds drop, and especially ETF that I'm buying into for long-term bonds. So every time I see interest rates go up, the yields on bonds go up, I'm buying into that ETF. And it really worked out for me. The decisions I made 2 years ago, I'm making money. I'm stabilizing my portfolio because those decisions were made when nobody really cared about bonds. And I don't think anybody cares about bonds right now. So I'll buy when nobody's looking. I'll buy when prices are dropping on bonds, giving me a better yield because yields are going up. And that's going to be part of my plan. I dollar cost average into my bonds, and I don't buy all at one time. So I'm going to be buying some more today. I bought some yesterday. I bought some on Tuesday. I think I bought some on Monday. So I'm just kind of filling that bucket of nice, steady bonds that pay a nice yield. And I still have a lot of cash to deploy on stocks. Now, I haven't been buying a lot of stocks this week. The buying has been a little tricky. Now, some sectors are doing better than others. Utilities has been on a tear. Just complete surprise to me. I dislike utilities. And a lot of investors really like utilities now. The whole story around AI is going to need, all this power is really driving that utilities are going to be really valuable. That might be the case. I don't believe that, but right now, for especially the last month, my thought process has been completely opposite to what the market's been doing with utilities. Utilities have just been flying up. Some utilities have really appreciated fast. And technology, no big surprise, it's doing great. Over the last year, it's number one. Over the last 5 years, it's number one. And it's number one by a broad margin. So technology is really working. Communication services is doing good. That's where some really good companies and then some old school companies are at. And then the sectors that are not doing good, energy, really dropping. And I'm trying to lighten my position with Chevron. I've sold calls on Chevron. And the good news is that I earned a premium in the month of August. And it looks like I'm going to earn a nice premium going forward because I put the call out there. I sell it. People buy it. And I'm just earning the premium. So I'm going to keep doing that on Chevron because I intend on lighting up or lowering the number of shares I own in Chevron. Energy's just not getting it done. Oil companies are not getting it done. I like the dividend. It's a good thing, but I have too much of it. If you look at my energy stock, that's my one energy stock. I own $110,000 of it. I think I'd be better off if I had maybe $90,000 of Chevron, and that would kind of lighten the exposure to energy. So I've sold the call, got it out there, earning $132. if it expires out of the money. I think it's going to, especially with today. Stock prices are really dropping. So that's part of my plan. I'm not saying I'm getting out of energy. I'm not saying I'm getting out of oil. I'm just kind of rebalancing a bit, just saying, hey, you know what? My other stocks are doing great. Chevron's not doing great. It hasn't done great for a while. Maybe I can lower my exposure to it a bit. All right. So that's what's going on with the stock market. Let's get into some stocks that some people wanted to look at. Let me take a look at some comments first. Then I have a list of stocks that people have been suggesting. So Mike, good morning. Good to see you. Cool. You're buying into our oil pre-market. Hawker, booyah. Yeah, it's a booyah day, man. The bulls are running. They're running. How you doing this morning? Hey, I apologize. I can't pronounce your name. It's Ladioyi. And but I really appreciate the comments you had yesterday. I think you had a lot of value to the conversation around lithium. So keep it coming. Please keep it coming. Excuse me while I drink my coffee. Till the end. Hello, sir. Did you watch the Meta presentation? I read about it. I did not watch it. I was really busy yesterday, but I did hear that they reduced the price on their Oculus headset and they came out with some glasses that are augmented reality. Two stories that it really drove the stock. So it was good stuff. I like that Meta continues to evolve and get bigger. That's good stuff. And Mike, does everyone else have commercials during these presentations? They drive me nuts. My apologies. That's YouTube doing their thing. I know that I subscribe to YouTube Premium and I avoid all ads on YouTube, but I know that costs money. So it's your decision on that. Let me know if it continues to be an issue. I'll see if I can adjust anything on their settings. But thanks for letting me know. Android PC. Good morning, sir. How you doing, man? Looks like AJ. Thoughts on Google and Spotify? Yeah, glad to do that. See if we have time toward the end. I've got a pretty good string of stocks, but we'll try to get to it. We did cover Spot. I'm going to say 2 or 3 days ago. So if you want to look at that recording, there's one there too. Baba continues ripping. I know I think it was down a little bit yesterday. It ripped on Tuesday and it kind of settled down yesterday. But the good news is this is where I'm watching Trader Prad, and he looked at Baba and he looked at stuff that's interesting. One point I'll make on Baba is that it settled down above the low that it saw the day prior, because yesterday it ripped up. And that is sentiment that it's set to go up because it didn't go below its previous low. So that's the kind of stuff I get from a trader. It's not the way I think, but it's an interesting data point. Not necessarily going to define how I invest. It's just interesting to see. That's why I continue to attend his live stream every evening before a trading day at 8 p.m. Eastern. So take a look at that if you're interested in seeing it. All right. So did I have Bob on my list? I don't have Bob on the list. Yeah, I do have it. Okay. So we'll take a look at it a little later. All right. So let's get into it. I think we're going to start off with Okta. Okta is a company I am familiar with. They're a software company, and what they provide the market is some workplaces, some companies provide single sign-on, which is, they have 4 or 5 or however many different applications they want you to access. And it becomes quite difficult to sign into 5, 6, 7 different, systems. So they have single sign-on where you sign on to the Okta software and it gets you signed into the other systems, right? It does provide better security and efficiency for your employees. So they're not, spending a good portion of their workday just trying to figure out what their passwords are. So that's good stuff. Now, they are kind of a one-trick pony. They're, kind of in a narrow place within the software space, and they are competing against some giant companies. I would just put that out there. Okay, so they're a $12.7 billion company. The revenue is $2.45 billion. Forward PE is 28. Looks like the current PE doesn't exist because they lost a little bit of money. All right. Now they are growing quite nicely. That is good growth. Let me look at the quarterly to see how that's looking. Looks very good. Man, these guys are growing nicely. That's a nice growth rate. I was expecting to see like in the single digits, but that's a good growth rate. Looks good. Now, when we look at their cash flow, well, let's look at balance sheet, just make sure that's not a problem. They have $2.3 billion of cash in short-term securities. And for debt, total debt, they have less debt than they do cash. So they can write a check, pay off debt, move on. No debt problem. Very good. When we look at free cash flow, very nice. See how they've been positive free cash flows. Okay. $623 million of free cash flow. So I could easily cash flow plus the cash they have on the balance sheet. This company is worth 13, 14 billion in my mind, just quick math in my head. And they're valued at about 13 billion. So other analysts look at their earnings per share and they say, hey, it's worth more. It's worth 38% more if we look at earnings per share exclusively. Now, I use cash flow and discounting of the future cash flows as the principal valuation of a company. And I take 2/3 of that valuation. I take 1/3 of earnings per share because it should also be an influence in my mind. A lot of analysts cover this company, 32 of them. Some are quite optimistic about the company and some not too pessimistic. I mean, that's not way below their stock price. So in general, it's a pretty good company, and their earnings per share are supposed to do quite well in the year of 2025. So 2.66. So I wouldn't argue with this number. I think they're probably going to do it. And the other thing about Okta, so I don't think they're incredibly discounted, but they are discounted to some extent. Let's take a look at where their stock has gone or has been. And I'm also going to ask Meta, what is Okta? So Meta's been interesting to look at. It's been accurate more times than not. And I like asking it because it comes up with a couple good references once I ask it a question. So it's saying the fair price for Okta is estimated to be $103.78, representing a 38% increase from its current stock price. The forecast is based on the average rating buy from 33 analysts. Okay, we saw something similar just a minute ago. Okay, so I mean, there's favorable reviews. Now, software companies have been somewhat neglected a little bit because everybody's excited about semiconductor companies, companies that are building out the AI infrastructure of the future, and understood. So software companies are, I think, discounted because they're just not the flavor of the month. Investors are really, the shiny object in the market is AI. Okay, understood. And Okta is not really a player in AI. They're just a good software company. As we look at their stock, how has it done over the last year? It's not done well. It's down 6%. Over the last 5 years, it's not done well. And I think what may be driving some of the concerns around Okta, and it is real, is Microsoft has a single sign-on application, and Microsoft is a gigantic company. And customers may feel like, hey, I already buy a bunch of stuff from Microsoft. Why don't I just go ahead and buy their single sign-on software, their security software, and then I'll be good to go. And that might be the story that, qualitatively is worrying investors. And they're thinking, this is a small company at 2.4 billion. It's doing okay. It's growing nicely, but they have to compete against giant companies like Microsoft that provide a very good solution. Microsoft can squeeze Okta out if push came to shove. Microsoft may decide one day, you know what, we're going to include a suite of technologies for a customer. It's like one price, and it includes single sign-on. And then a customer is like, hey, sorry, Okta, but I'm kind of getting single sign-on for free in that agreement. So I'm going to have to stop using your service. That's just kind of my imagination going, but it's somewhat grounded in reality because that's how software works. So Okta, I think, is a interesting situation. I've been sitting on some software stocks that have not done as well as I would have liked. One of them being DocuSign. DocuSign is in a similar situation where they're number one in digital signature capture, but the stock really hasn't moved a whole lot. And you could say, well, because they're under threat from Adobe, understood. But usually the best user experience wins, and the best kind of adoption wins. And DocuSign is the best of both. They're very well used by business communities everywhere. Everybody kind of refers to DocuSign as a standard, and their user experience is really, really good. So DocuSign continues to grow, but the stock has done okay. It hasn't really been all that great. Both Okta and DocuSign are good targets for acquisitions. Like, they could be acquired by a bigger software company that wants greater ability in the space, and they want that revenue and they want that cash flow. It's a very attractive acquisition, in my opinion, for a bigger software company. So Okta's out there. I want to say that I want to watch it, but I probably shouldn't because I have DocuSign already. But hopefully those comments seem interesting to you, and good luck with Okta. All right, so I think Mike wanted to see that one. I think you wanted to see Now, which is ServiceNow. Let's start by seeing where their stock. Now, ServiceNow has kind of captured a little bit of lightning in the bottle by talking about AI. And ServiceNow is a software-based service where they provide a lot of, I'm going to put it in the category of customer support or technical support, where if you powered by ServiceNow, and you go in and you put in your support ticket. Hey, my PC isn't working, and the IT department for that company would then help you with that issue you're having. ServiceNow was look at their growth in a little bit, but they really kind of their CEO is a very tenured CEO. It's I believe it's Bill McDermott, and he ran SAP for a long time. So he's kind of a veteran of the industry, and he saw AI. And they went all in on AI, and it helped them. It helped them with their stock price. Let's see if the company is worth that stock price. So I'll kind of go reverse the order that I went in for Okta, and see if maybe that flow is interesting to look at. So let's ask Meta. This time I asked Meta, hey, I want you to base it on free cash flows. So it did. Cool. Very cool. To estimate fair price, ServiceNow using discounted cash flows. You need several assumptions. Assumptions, free cash flow rate. Okay. Okay. Man, Meta's good. So it did it all. Like it estimated what the growth rate's going to be, discount rate, terminal value growth rate. This is all in my model that I'm going to show you in a minute, or I'll show you eventually. And then free cash flows forecasted. Okay, they provide good free cash flows. So present value of their free cash flows is 15 billion. And then terminal value 44 billion. So the present value is 59 billion for this company if you look at their cash flows. And their current, leave that one open. So their current market cap is 183 billion. Whoo-hoo! That's pretty pricey. So when I look at now, and I'm glad that I started here, right? This is artificial intelligence saying, I looked at the numbers and frankly, it does a really nice job. And it's a $60 billion value to the free cash flows I expect from this company. And you look at, oh, whoa, that's pretty pricey. Well, the stock's been really going up. Okay. And it's not being priced like a software company. It's being priced like an AI company that's going to revolutionize the world. And it may be that the case, but I think it's overly ambitious to think that ServiceNow is going to revolutionize the world. Let's take a look at how revolutionary their fundamentals are. Well, first, it is revolutionary if you have a PE of 160. At that rate, you know, who cares about PE? It's 160. That's outrageous. But it's going to come down just to 60. And this is a company that has to compete against CRM, Salesforce. Salesforce is a gigantic company, and they're very good. They're very strong. They also have to compete against Microsoft, a gigantic company. They're competing against some giant, very well-run companies. All right, so the numbers do not match exceptional. They do not match, wow, AI is going to be incredible. Okay, why don't we have incredible growth? And they're small. Okay, they're 10 billion. Let's look at a CRM. So this is Salesforce. Salesforce is bigger and they're growing. So Salesforce is 3.5 times bigger. They're growing at 10%. ServiceNow is supposed to be incredible. They're, again, smaller, and they're growing 24%. It's like, well, incredible is 100% growth. And I have to say, NVIDIA is incredible. NVIDIA growth rates were incredible. Those are incredible numbers. But there's a lot of companies that are being, it's kind of like a rising tide lifts all boats, right? Well, if you convince the market that I'm an AI company, okay, then you have to rise with the AI tide. And ServiceNow has certainly risen. But as I consider AI in this, space, I just don't believe that now is going to be a big player in AI. I think their competitor, Salesforce, they've already had an AI business. They just didn't kind of go all in on AI because AI is supposed to be both an opportunity and a risk for software companies. If you think about, ServiceNow, let's call it 5 years ago, the paradigm was you go to ServiceNow, you put in a service request, and it goes to a human being. That human being could be, in the same office you're in. They could be on the other side of the world where there's a lower cost of, labor. And they help you with that issue. And we get done. With AI, especially AI around support, it is going to be innovative. It is going to help. It's going to eliminate a lot of seats of software that both Salesforce would sell as well as ServiceNow. So it's actually going to disrupt their business because you're going to have a computer answering those questions. And maybe the computer can't answer everything, but if it answers 90% of questions, I'm showing the ability of Meta AI. That's pretty darn impressive, right? Well, if a company has like 80% of their service tickets are around 20% of these questions or these, problems that employees or customers are having, it's going to knock out a pretty good percentage and do a good job of it and leave the remaining 20% for a human being at the company to deal with. So I think that this growth rate for ServiceNow is going to go down, and it is going down if you look at the quarterly. So I could see ServiceNow, their revenue is going down to 15%, then 10%. And the magic of being incredible because they convinced the market that they're an AI company may have left the bottle. And so ServiceNow is really overpriced in my book. Even analysts who are usually part of the euphoria, they're saying it's overpriced, but not as much. 4% is nothing. Let's take a look at their forecast. You have 26 analysts looking at it. You have some analysts that are being realistic, like, hey, it's overpriced by a pretty good margin. And again, it doesn't have an incredible growth rate. You look at this growth rate in earnings per share. That's not incredible, 20%. And you know those forecasts are probably going to be a little high. So ServiceNow, it's a complete pass for me. I may take the opposite position and start shorting ServiceNow. But I'll do more homework and I'll let you know if I decide to do that. Two good software companies. Thanks for suggesting them, Mike. I think it's good to take a look at software companies when they're not as desirable for everybody. All right, let's look at SCHD. Let's take a look at that. So, okay, so Schwab US Dividend Equity ETF. So Schwab US Dividend Equity ETF is the exchange traded fund that is based on the Dow Jones Dividend 100 market cap index. Okay, cool. Okay. And it pays a nice dividend at 3.5%. Okay. Now, having an ETF on the Dow, that really reduces risk. Like if you have a stock, you could have a good company, a good business, but their stock price goes down 15% over the next, year. And that it's hard to stomach because you're like, oh, it's a good company, but the stock price is down. Well, when you have an ETF, it's going to follow the Dow for the most part. And the Dow is made up of 30 companies. These are all big companies, very well known. A lot of them do pay dividends. They're pretty solid. We're seeing that the economy is in good shape. It's growing at 3% GDP. Unemployment's not a big problem. And you got China that's growing even faster. A lot of these Dow companies do business in China. They either sell to China, they have their products made in China. So those things this is a pretty good option. Having an ETF. Now, right now, I'm sitting on, I don't know how much cash I have from a percentage standpoint. But I'm going to guesstimate I have like 14% cash right now. And that's a pretty good cash position. Now, I'm not jumping into equities headfirst right now. I think the stock market's expensive. And the market is like, it doesn't care what I think. It's like, whatever. Wait, what the heck? I thought we were going to open up much higher. What's going on here? There we go. So the market doesn't care what I think. The market's going to do what the market's going to do. And today the market's up quite a bit. So I continue to think the market's expensive. Now I'm still buying. I'm still buying into Amazon. I'm still buying into certain things. This is not a bad idea. This is going to work for the next, 12 months. So I think it's a pretty good idea to put some money into an ETF. I'm trying to find a few stocks that individual stocks that I can take out of my portfolio, and I want to be more concentrated. But I am buying into an ETF of long-term bonds. Not ready to look at this one because I own a couple of Dow companies, so I'm good to go. But this is a good idea. So good luck with it if anybody who's interested in this ETF. And you can't really do discounted cash flows on this or earnings per share. You just have to. Let's ask Meta. Meta's smart. Trader Pratt, good morning, man. All right, so, and then Mike's got a comment on SHD, which is not SHD. I was telling you they have it. Okay, all right, sorry. I think I went down the wrong road. So ATKR. Okay, we'll do that one next. So just to finish off my thought here. So their fair price is $83.55, and it's fairly priced. So no big surprise there. All right. So moving on. Okay, so the other stock that we want to look at is ATKR. What company is that? So Atcore. What do these guys do? All right, so Atcore Incorporated engages so they manufacture and sell electrical, mechanical, safety, and infrastructure products and solutions in the United States. Okay. Now, some of these companies have been really rallying because they're supposed to benefit from a data center build out. And that may be the case. So we'll take a look at their revenues and see, are they really seeing explosive growth? Really amazing explosive growth. Now, 40% down. Man, this is I believe these guys should be classified as an industrial. So this is surprising. Holy smokes, what's going on? It's down substantially. PE, geez, 5.89. Is this a misprint? Forward PE, 7. That looks really good. Dividend is there. It's discounted. Why is the market not liking this company? Why is the market saying, I do not like Atcore? I do not like them. I just would prefer not to buy this stock. Why is it? So they're in construction. Understood. That's what they do. They do electrical. So when you're building something, you're going to build it with this stuff. So they're doing this kind of stuff. Let's see if they can tell us markets. Here we go. So they're in commercial industrial. Now, commercial real estate is, pretty bad right now because everybody's working, or a lot of people have remained working at home. So these office buildings are somewhat empty. Data centers, utilities. Well, these guys are rocking the world. These guys are rocking the world. Solar. Okay, solar's down a bit. And I think if you have the Democrat win the presidential election, I think solar stocks are going to rally because the Democrats are going to want to put a lot of incentives out there for people to buy solar, as well as commercial. Like they'll have incentives for businesses. Hey, if you can move your energy consumption from it being more of a legacy kind of, fossil fuel based to solar, we'll give you a X, benefit. Then water, transportation. So these industries are pretty good. I mean, I like the industries that they're selling into. Let's take a look at their performance and see what that's all about. All right, this is where we're seeing the problem is their revenue's down. this is what's causing the downturn in their stock price. Now, I don't expect this company is going to be down forever. They've been negative growth for 6 quarters. What's also concerning is they're 7 quarters, 7 quarters, and the growth rate is pretty negative in the more recent quarters. When we look at the company in 2022 was 3.9 billion in revenue. Now they're 3.2. This tends to be construction. Like construction companies tend to do this. They have like a really good year. They built this big project. It was, revenue through the roof. And then there's no big project to replace it. So the revenues go down. So that's nature of this industry where you're so tied to construction. That said, construction companies do not get valued very high. Stock market loves up and to the right. It likes revenue to continue to go up and grow. It likes free cash flows continue to go up and grow. You could even kind of get a pass on your revenue growth like Apple if you can keep growing your free cash flow and buy back shares. So the market just doesn't like to see really negative numbers. It'll be interesting to see if Apple starts, dropping their revenue, because right now they're dropping by like just 1% or just a tiny bit, which is concerning to me. I'm shorting Apple. But if Apple starts just dropping 5-10%, whoa, I would think that people would exit the stock, but I've been surprised to this point on Apple. This company here, just one reality for me is they're being priced like a construction company. I don't own any construction companies for that reason. Is you have the up and down business and the valuations of these companies. Let's take a look at them historically. See, they really had a nice run up because they had good numbers. They are nicely up 188%. Man, that looks pretty darn compelling. I think these guys can bounce back. At some point, they're going to start growing. And if you can follow this company and buy at the right time, you're probably going to be sitting on a winner. Again, back to the economy. The economy is growing. China's growing. These guys are probably exporting some of their product out to China, probably helping the world kind of build out their projects, data centers, solar, all that good stuff. And commercial will fix itself, right? The whole adjustment in commercial has been known for 2 years. So at this point, commercial office buildings, I'm sure some of them are still empty, but like warehouse space, it's full. They can't build enough warehouse space. So this stock's a good one to follow. I think I'm going to be following it and seeing when would be the right time to consider this company. Now, before I do that, I should check their balance sheet just to make sure it's not like got a bunch of problems, bunch of skeletons in the closet. Cash and short-term investments, $303 million. Long-term debt total debt is $921 million. Okay. So net, they have about $600 million in debt. And their EBITDA is $830 million. So they can pay off their debt in a year. Boom. Good balance sheet. Okay, good. Some analysts are quite optimistic. Only 5 analysts cover this company. What was their market cap? $3 billion. Dude, this is a small cap. This is great. This is an example of small caps. This small cap did well for a while, but more recently, it's not doing well. So it goes to show that some small caps are not being treated very favorably by the market. So back to the valuation based on earnings per share. So it looks like here their earnings per share for 2025 is going to go down and then it's going to go up. And analysts are pricing it that way. It's still going to be in the green. I mean, that's good. So it might be like in early 2025, as we begin to see this growth on the horizon for 2026, that's where, see, the revenue growth is supposed to begin to increase in 2026. So this would be a good stock to follow for a quarter and see if I want to buy it like in early 2025. So I'm going to put this one on my watch list and see if it's a good buy in early 25. And just to double check, I believe it's a industrial. Yeah, it's an industrial sector company, and the industry is electrical equipment and parts. This is a good one. Might be a little early. Again, I continue to think, man, the stock market's a little expensive. We got to be careful not to buy too much. If I could be a little patient, wait until this election's over, and we know what's going to happen, from a government standpoint, I think I'll be better off. The NASDAQ is up 1%. Over the 1 year, it's up 40%. Whew. Let's thank the universe for that kind of return on the NASDAQ. Over the course of less than 2 years, it's up 74.5%. Very good. So stocks are working. Stocks are working quite well, especially today. And, this is the kind of day where I sit back and watch my portfolio and go, nice. I like making money without even typing, and go to the backyard, drink a cup of coffee, come back later, watch the market close. With a few exceptions, if I see a couple of stocks move and become like, I think I mentioned I wanted to buy that ETF for long-term bonds. I probably will pull the trigger on that, and we'll see where Amazon is trading and a few other stocks that I'm trying to build up on. All right, so that was Atcore. Looks really interesting. Looks really, really interesting. Now, there's a company that came up on a different, I think I was watching the Schwab Network. Pretty good show. It's, you have like CNBC, Schwab Network, Bloomberg. Those are kind of like pretty well produced, professionally produced, business channels. And on the Schwab Network, they came up with Caterpillar. And they were showing some graphs, and I'm like, that's surprising. I haven't looked at CAT in a little while, but this is what surprised me. It's up 46%, but Caterpillar kind of goes up when the economy is going up and when construction is high and, agriculture too. So I'm like, whoa, why the heck is it up 46%? I think this is a Dow component, by the way. And dividend is 1.4. Okay. PE is 18. Okay. That's pretty good. Market cap's 190 billion. So let's take a look at this guy just real quick, just a quick flyby, because it surprised me that it's doing that well. What's it doing today? It keeps on this tear. It's like, what? Caterpillar? Why the heck is Caterpillar, rocking the world? This is a real solid company, really strong moat, competitive advantages, all those things, very strong company. The brand is super good. So I like that about them. It just surprised me. And I'm like, what the heck? They are certainly a crowd favorite. Their market cap of 191, 66 billion in revenue. PEs look good. 18. 18 seems kind of low in today's market because this is a very well-known company. It's an industrial, farm and heavy machinery. Okay, fine. I think I showed you in Atcore that construction has ups and downs, and if there's going to be a big project the government's going to do, maybe some new machinery has to be procured from Caterpillar. Now, the stock has been sensational. Let's see if their growth has been sensational, but their trailing 12 months is well below sensational. It's not even close to sensational. Negative growth rate, anti-sensational, the opposite to sensational. Sensational is like Taylor Swift, Super Bowl. That's sensational. Negative 3.63 is like, whoa, how come they're losing revenue and the stock price is going up? Huh. That's why it surprised me. I'm like, huh, what am I not understanding about Caterpillar? There's a story out there where the market's like, oh yeah, Caterpillar is going to be awesome. So BHP to test Caterpillar's new energy transfer system on its mining trucks. It transfers energy to diesel, electric, and battery large mining trucks. Wow. So I know this is how locomotives work, right? They have a diesel generator and they have electric motors. That's how locomotives work. Thanks to my brother-in-law, the dude is when I say he's a rocket scientist, he used to work on the space shuttle program. So, and spaceships. So he is a rocket scientist. So he explained this to me when I was a kid. He was, I think he was dating my sister or had already married her. And he explained locomotives and why, because you can, electric motors are, the torque on electric motor is very, very good and consistent. You have a consistent band, where internal combustion, you tend to have a torque curve, and that is not good when you're just trying to move a big piece of machinery nice and slow, nice and smooth. Diesel is better than gasoline powered, but when you get compared diesel to electric's superior. That's why locomotives use the electric motors combined with diesel. So this isn't like, oh my God, this just, was invented last week kind of situation. So it's cool that they're doing that, but not a big mover. So Caterpillar, I'm not quite sure why they're being priced the way they are. But hey, man, Caterpillar's solid. Caterpillar's solid. I don't view them as, even the analysts that look at their earnings per share say it's overpriced. I could almost guarantee you that I would say this is grossly overpriced. Let's see here. So free cash flow, trailing 12 months, 10 billion. Very good. See, their cash flow has really gone up. And you see how it's always been positive and it's grown. Wow, that's really good growth. Now, their growth is negative. So the best I can do is maybe 100 to 120 billion dollars of value on this stock, assuming their balance sheet's in good shape. They have 3.4 billion in cash, and they have 37 billion in total debt. Ugh. That's a lot of debt. So yeah, I'd be stretching it to try to get to $100 billion valuation. I'd probably be at 70 to 80, and they're way up there. Holy smokes. People like Caterpillar. People really like Caterpillar. Congratulations to Caterpillar stockholders. But I wanted to look at it because the times I've looked at Caterpillar, I'm like, okay, I'm not like overly impressed with their growth. I get they're really good. I get they have moats. I get all of that stuff. But I think it's overpriced, and not by a little bit, by a lot. So thought that'd be interesting. All right. Mike wants to look at NEP really starting to move. What is NEP? So Nextera Energy Partners. Yeah, it's starting to move. So I think we've looked at this one, and they are an energy publicly traded subsidiary, renewable energy company. I mean, the utilities are just screaming up. And this one, so market cap's only 2.6 billion, revenue is 1 billion. PEs are really low. Wow, dividends super low. I mean, dividends super high. Revenue looking good. Okay. And so this is where I always hit the wall with utilities is they don't produce a lot of free cash because they have to put in so much capital into their operations. This one's okay, but see, this is where all the profits go is back into CapEx. Oh, we got to replace all the energy producing equipment. So it's not like a Meta that, oh, cool, 80% margins and we get to do whatever we want to do with it. So we're going to create we're going to buy an Oculus, a virtual reality company. We're going to invest in glasses to give you augmented reality. We're going to build an AI model and Meta AI. We're going to do all this fun stuff because we have so much freaking free cash. This company, not so much. This company, you have to abandon free cash flow valuations and probably look at just purely earnings per share. And based on earnings per share, 15 analysts look at it. It is a well-priced stock. So, if you want to be in a utility company, this isn't a bad idea. Their earnings per share is supposed to come down, but it's still going to be positive. But the stock hasn't really been overly priced for a long time. In fact, it's kind of been beaten down. So the dividend is super high. Can they afford that dividend? The dividend is exceptional, right? So looking at their dividend history, man, they've been raising it. Man, it does look interesting. I must admit, this looks interesting. I'd have to reconsider and kind of go, okay, what's their operation about? How do they create their power? So NextEra Energy. Okay. Yeah, I've looked at these guys. So they do wind, solar. Again, if you see an election go with the presidential election being won by the Democrats, this stock's going to bump up 10% because it's like, okay, the Democrats are going to want to build more renewable energy and put money out there. And NextEra Energy is really going to benefit for the next 4 years. So, I mean, this one looks interesting. I have to admit, I'm going to do some more homework on it. I cannot use free cash flows because we know that just doesn't work for utilities. But it's worth taking a look at. It's worth considering. It's really working. The utility space is on fire. Investors want to own utilities. And we'll see how that plays out. But these guys have been kind of left behind. I know of utility companies that have similar financials as NextEra, and they're up 300%. It's kind of nuts because if you're up 300%, at least show me that, hey, you are rocking the world. You are growing really fast. And that's what's been somewhat surprising. And here's what's interesting is once companies detach themselves from valuations and the market says, oh yeah, you just can't value that company. So it could be as high as the market wants to trade it. That's totally in play with some AI related stocks, especially utilities. And that is a game of how long is it going to last? Because at some point, the companies will have to price themselves based on valuation. It's, for a period of time, those stocks will scream up, but at some point, the reality will set in and they'll have to be priced based on what's your revenue growth, what's your earnings per share, how are you going to return capital back to your investors? How will an investor walk away with more value from that investment. And if it's just, hey, well, everybody bought a $20 bill for $1,000 and everybody kept buying them. So it went from $1,000 to $20,000 to $25,000 because everybody wanted that that type of $20 bill. Okay, at some point, everybody's going to be like, okay, there's no more buyers of a $20 bill at these levels. So what's this thing really worth? Oh, it's worth $20 and it'll crash. So that's the way I think. That I'm going to stick to my lane. I think NextEra Energy looks good. I think it looks good. It looks interesting. I'd like to kick it around and analyze it and see, is that a good play to be in energy? Because utilities are rocking the world. And for all I know, utilities are going to be good for the next couple of years. I'd like to do some homework and learn something. So thanks for asking about that. All right. So yeah, we looked at NextEra last month. So David, so BTBT, I'm not holding it. I just needed to trim back my portfolio. I think I'm watching it. I still think they have a very interesting business where they're originally a Bitcoin miner, but now they're doing GPU hyperscaling, providing that as a cloud service. So I still am favorable on BTBT. I just needed, and let me double check. Sometimes with my memory, yeah, I'm pretty sure, but let's take a look. So I have my crypto. I have Coinbase, but I don't have BTBT. I am watching it, and I believe that it's a good stock. Has it been working? Because I got out of it. I think it's a good, interesting play. It's up 1% in the last month. So it came down, then it went up over the last couple of weeks. It's really worked, huh? 51%. Jeez, man. Amazing. Oh, man. Awesome. Hopefully you made some money, David. And again, I'm watching BTBT. Potentially I'll get back into it. I just needed to simplify, concentrate my portfolio. That way I can watch my companies closer and really hold them if I want to hold them, or even invest further into them. Part of that reasoning is I'm sitting on really good gains. It's been a really good year. It was a really good year last year. Okay. Now I got to take some of that appreciation and lock it in. At some point, the market's not going to keep going up. And I'd rather lock in gains while it's good. Okay, cool. And then, Mike, you've owned NEP. Very good. Yeah, it looks interesting. So thanks for asking about BTBT, David. Let's see how it plays out. All right. What's the market doing? What is going on, stock market? So the NASDAQ's still up 1%. Russell is showing up. S&P. It's going to be a green day, man. The economic news was very good. So I don't think the pessimism on the economy is going to be a story anymore. There was a story that, could potentially derail the market. Now, all we have to worry about is, in my opinion, it's an expensive market. And we have this election for president in the United States that is going to add a little more concerns out there. But let's see how it plays out. So that's the live stream for today. Thank you to everybody who attended. Special thanks to all the paid members. I appreciate it. We've had a couple of new paid members. Really appreciate your support. Everybody, if you could become a paid member, it's $10. It'll be on the description of this live stream. And I am going to move up the rates probably after the first week in October. I'm putting my plans together to update the member program this weekend. All current paid members will hold their price and always have the best level of benefits for all the different member levels that I create. as a big thank you for being early supporters of the channel. If you're not a member of the channel, I encourage you to do so. We've got a good thing going where we do collaboration, and there'll be member benefits on your membership as well, like having access to tools that I use, that you see me use, as well as a member conference call each week that you can attend and have access to, where we can talk through stocks and have a conversation around them. So with that, everybody, thanks for attending. Enjoy your Thursday. Hopefully you make lots of money on this stock market that is appreciating. And I'll be back tomorrow, same time, 9 a.m. Eastern, 6 a.m. Pacific. Everybody have a great day.